Hello everyone, and welcome to this ACT webinar, Smarter Commodity Hedging, Time for Treasury to Take Action, sponsored by OpenLink. This is the ACT, and my name is Peter Matzer. I'm the Speaker's Chair, and it's my pleasure to be moderating this webinar for you today. The ACT will be tweeting before, during, and after this webinar. We would encourage you to tweet if you feel you have something to add to the debate. You will note that you can follow the ACT on @ACTUpdate, #ACTwebinar. You will see on your webinar screen that there's a menu bar across the bottom that allows you to open various windows, and you can move these around your screen, resize them, or minimize them as you wish. The yellow button with a question mark is for help if you have any technical difficulties, and the webinar producer will answer them as and when you have those questions. The purple Q&A widget opens a new window. You can send questions to us by typing in the window. Please don't wait until the end to send in your questions. Do send them in as they occur to you, and we will be dealing with them at the end of the presentation and during the conversation that follows. Please note, we won't be disclosing any names. I should add that a recording of this webinar will be available on the ACT website in 2 days' time, along with a separate copy of all the slides. Joining me today on the webinar are Tasha Botha, VP Capital Markets and Corporate Treasury at OpenLink, and in the panel discussion, Mashal Jaffrey, Senior Manager at Baringa Partners. So what I'd like to do now is invite Tasha to lead off our conversation today with her presentation. Tasha.
Thank you very much, Peter. Really appreciate it. As Peter said, I'm going to give you a little bit of an overview of the smarter commodity hedging and why it is time for treasurers to take action today. So as Peter gave you a little bit of an introduction of myself, I am the VP Capital Markets and Corporate Treasury here at OpenLink in EMEA. And so from my view is I'll give you a little bit of an idea and an overview of what is actually going on with our client base today and why they say that being a smarter commodity hedger is important. So, a Treasury Manager's DNA is to plan, organize, and control cash and borrowings so as to optimize your interest and currency flows, as well as minimize the cost of funds. But a treasurer's role within an organization is changing from being a cost role to more of a strategic role within the company. Now, besides the concerns around risk, compliance, globalization, and also being too thinly staffed, the other things that keep treasurers awake at night are things like digital versus cash payments, marketing regulations, even shareholder value. But today's webinar, we're actually going to focus more on the other bits, which is the risk management and liquidity optimization, as this is one of the key activities required to help a treasurer identify opportunities for optimizing of liquidity as well as funding. So from baked goods to white goods, manufacturers across the range of industries are confronted with challenges of managing a thin margin. They also need to be mindful of commodity price risk has the potential to cause substantial P&L volatility. Just recently, we saw a chocolate manufacturer's balance sheet come under immense pressure with the turbulent milk prices out in the US. And who can forget those airlines that came under immense pressure with the volatility of the price of oil? So traditional procurement groups have tried to mitigate this kind of impact that these price strikes by locking in volumes and prices over a long time horizon. Unfortunately, this traditional approach means that cost savings are missed and that hedge strategies are suboptimal. as they are reliant on spreadsheets as well as legacy technology. It also leaves vulnerable to fraud, human error in data input, as well as the ability to easily troubleshoot. These all can lead to inconsistencies in one's balance sheet, which then means you have to get into the manually address all the accounting and on the reporting front. So now I can hear you ask, how do commodity-intense corporates then move forward more into this integrated approach where the business can become more agile in procurement approach? Well, I'm sure you recognize this picture far too well, where the forecasting of the raw material is determined at source, and that source tends to be decentralized. They then fix price contracts are negotiated in terms of volume as well as prices for what they need. This forecast is then sent through to head office to release the cash so that they can actually purchase the raw materials. And then head office builds out the various hedging strategies to cover the corporate exposure on both the commodity as well as the FX front. Now, traditional procurement methods are there to negotiate those fixed contracts, sometimes at spot price, or sometimes the price is closer to delivery time. Now, as you can all imagine, a few years ago, there was a bit of a stable market in the commodities front. So monitoring this could be pretty straightforward. And for quite a few of the commodity-intense corporates, took the decision to actually reduce their hedging activities and to control their balance sheet fluctuation more by using these kind of fixed price contracts. But now, as you can see in the last year, commodities prices are starting to move up again. So what happens then if your commodity price moves up and down prior to your delivery date with these fixed price contracts? You would have no choice but to follow the market. Or what happens if your hedging strategy is on product level rather than on raw ingredient level? And one of the ingredients you require to make your end product becomes volatile. You would have no choice but to change your entire hedging strategy rather than reacting to a specific raw material hedge. So as you can see, both these incidents would land up impacting your P&L and could land up costing your firm a bundle of money. So with commodity prices on the rise, we've been seeing a lot of commodity-intense corporates are wanting more specific hedging strategies, as this enables them to be a lot more specific with their reactions to the underlying raw material movements. So for example, one of our commodity-intense corporates, they sell bread to the market. And they actually have their hedging strategy on ingredient level, not on product level. So it's not on the bread level, it's actually on the ingredients. So the ingredients being butter, sugar, milk, wheat. So as the market moves, the price of wheat goes up. But the price of flour nor butter stand still. They don't move. So our commodity-intense corporate only needs to adjust the strategy based on the wheat movement. They don't need to make a generic position change for the entire commodity range. So this could save them millions annually, not only in fees, but also on margin call, for example. So the trick for us is our commodity-intense corporates use this one single solution that enables them to move towards a more agile approach. So that means they can actually react on the ingredient level rather than on the product level. They also have the ability to promote enterprise-wide transparency and efficiency. But more to the point, they can actually optimize their hedging across not just one single silo, but across the entire company, which helps them to enhance their compliance, position keeping, as well as the auditability and traceability, because there's no manual intervention required. So what we've discovered, the key thing to success on these particular CIC environments is that you need to ensure that the technology that you use understands not only the cash movements, not only the financial hedge movements, but also the commodity hedging on an ingredient level across both your financial as well as your physical products. And I think key above all is also to be able to understand that commodity risk skill inside the corporate treasury function, not only outside in the decentralized world of procurement. So hopefully that gives you today a bit of a flavor of where we've seen at OpenLink how a lot of our commodity-intense corporates are really trying to understand the market from an ingredient level, not just from a product level, and that they can actually make cleverer decisions and make more tactical decisions so that they can actually land up not costing the company millions per annum. So Peter, I hope that gives you a bit of a flavor of what's happening in the world of OpenLink and the commodities, and hopefully we can have a little bit more of a discussion around those points.
Thank you very much, Tasha. That's very helpful to give us that overview, and I'm sure there'll be more than one or two of those points that either people will wish to raise questions on through the webinar, or indeed ones that I may raise from here. But what I'd like to do first is bring in Mashal Jaffrey to the conversation. Perhaps briefly, Mashal, you might care to make one or two opening remarks about where you've sat in this process and the role that you may have played in helping corporate look at this as a risk management issue.
Hello. So I'm a senior manager at Baringa Partners Energy and Resources practice, and I have helped corporates develop and integrate their treasury and risk management capabilities. This has become a lot more relevant now that we're seeing the transition from people looking to understand where their risks fundamentally lie, and it's helping those kind of organizations which do have heavy commodity exposure to build those technical capabilities and hire those skills to allow them to effectively run their businesses, quite similar to what Tasha has just mentioned.
Okay, that's very helpful. Thanks very much. Want to get into one or two general questions at the beginning, and please, both of you, feel free to answer at any particular moment. Tasha, something that I know we talked of before that I think hopefully listeners will find interesting is how you view the capability of the corporates you go and talk to fully understand what their exposures are, and perhaps how they can better understand those exposures if they're struggling to get to grips with them.
Yes, so I think the biggest thing that we've seen through our corporates is that traditionally the world was very segregated. Procurement was in procurement and treasury was in treasury. We find that the most successful case of being able to tackle this particular nuance, because commodities is a thing that people didn't always really understand. It was something that was sitting out there that just had a movement per se. And treasurers are trying to get a grip of this because it's actually affecting their balance sheet. And the board members and the key shareholders are saying it's starting to affect the balance sheet, so therefore we need to get a control over it. So what I've noticed is that a lot of our clients will either go out and hire a specific commodity hedging stroke risking specialist to actually sit within the treasury function and work alongside the procurement. So it's not there to replace procurement. It's more there to actually understand the procurement's needs, requirements, and then be able to articulate that in a treasury function. That's where I find the most success is, and then you start building it from there.
Mashal, would you agree with that?
I would. So I think one of the trends that we're seeing is an evolution in Treasury to more actively risk manage, almost like some of the banks do. There's a trend of convergence between corporate treasury and risk management. And what we're seeing is essentially that this function is not really now being seen as a cost center. it's now being seen as a center which will allow cost savings in other areas as well. So it's the shift between, do we just invest in revenue sources, or do we optimize our operations internally and realize value which we previously did not have visibility of? So one of the traditional areas where you would see that cash is no longer now seen as a byproduct for corporates. It's an actively managed area. At the same time, they're also looking at how can we increase our operational transparency for our commodity exposure. And that's the point where you talk about procurement of buyers. What role do they have to play? And do we need to have a specialist set of skills for commodity analysts? And how do these two groups interact, and how do they work with Treasury to better manage the P&L of the business?
That certainly accords with what we at the ACT know from our recent research and the information flow we get from our members around the world, that their collaborative elements of their role, the breadth of their role, and the importance of wider risk management is being seen much more as a strategic issue for the business as a whole, rather than, if one may put it this way, a compartmentalized activity. Moving on from that, Tasha, if we accept that businesses have to work hard at finding out that information and making sense of that information, what then would be your advice to an organization as how they evaluate the importance of whether they have exposure in certain commodity or raw material or production areas, as opposed to the other elements of risk management within their business?
Yeah, okay, so very good question, Peter. So what we find is that corporates with low margins are the ones that really get hit by exposure along the food chain. So for example, if you look at one of our airlines, with the price of oil moving and the volatility of it, it really affected their bottom line because they can't change the price of a ticket, for example, to the market. So therefore, they'll really have to manage that risk of the oil moving all the way through to jet fuel, for example. One of our other clients is a cans manufacturer. And for them, the metal is a very, very important commodity for them to actually manage, because the fluctuation in that price affects their bottom line. So they would really need to, and what I think in corporates, a lot of corporates say to me is, risk. We don't take risk. We're not there to make money. It's not about taking risk to make money. It's really about protecting your money. It's protecting what you actually have rather than there to trade and make money per se.
It's an interesting point. What's going through my mind there is something to do, and Mashal, I'd like you to answer this as well, to do with the policy setting process. Our business is starting, if you like, at the ground up and saying we've identified we have these exposures to a bread manufacturer, to wheat or to sugar, to an airline, to jet fuel or what it may happen to be? Or do they start from the top down and say the primary role here is effective stewardship of the company's resources and its financial position, therefore we need to look and understand those things that could threaten that? When you're talking to clients, do you see one or the other, or a mix of those approaches?
So I think in what we've seen with clients is it almost inevitably starts with a business case, and often there's a trigger behind it. But what we're also seeing is that clients are becoming more proactive. So I think one of the examples relating a bit to what Tasha said was when we had Brexit, that really hit a number of corporates in a lot of ways that they didn't anticipate. The cost related to the FX component of some of their commodities shot up. And that's when they really started to think, right, we need to actively manage this. So it does come from from both ways. One is, what are our margins looking like? And then secondly, what are the fundamental underlying drivers for this? And when you're talking about policy, you're kind of having to define what is the remit of Treasury. Are we going to give Treasury a measurement P&L? And again, what you're not saying is that they're actively taking risk, but they're a custodian of value. And how can we enable them to maximize that value? So that's the question that businesses need to ask. But inevitably, it all goes back to, if we want to invest in this, because it's a program. It's a transformation program that you're investing in, which will touch many areas. What is the business value that it is going to deliver?
And Tasha, do you see more, if you like, from that bottom up, these are the inputs we have, or do you see more of the top down, this is protecting particular metrics of the organization, or again, do you see a mix?
To be honest, I see a mix. We tend to find that the corporates that come to us are corporates who, as I mentioned to you, really have a small margin. They really and truly have to protect that margin. Now, the way they protect it is they will either create what we call like a hedging platform, and that hedging platform is what we could call a derivatives play, and they really want to manage that derivatives. So they will then want to manage that derivative not just on the end product, as I mentioned previously, but actually on those intricate ingredient level side of things, so that they can actually make strategic decisions so that they can actually protect it. So to be honest with you, I think it's a mixture of both. It's both top down and bottom up.
Mashal, I know that you've recently been working with a large UK FTSE organisation that's taken some steps towards this. Is there anything from their experience that you're able to share that addresses either that sort of bottom up or the top down or the mix and match process?
Yeah, I think it comes definitely from both ways, and in that particular experience, I'd say there was a clear definition of where does the business want to go, where do they want to realize additional value. So where are the synergies that we're seeing between procurement and risk management and treasury. And the reason why a lot of this naturally was kind of sat or converged towards treasury, because treasury was the market-facing world for a lot of organizations. So they're the ones who are accessing a lot of the trading platforms. So they naturally have the understanding and the skills of how to manage currency exposure or how to manage liquidity. Similarly, they wanted to extend that capability to be able to manage commodity exposure as well. So it was essentially just building upon some of the skills they already had and adapting it to their business. Secondly, what's quite important is a lot of large corporates might have presence which in different entities, in different countries. And at that point, group treasury becomes really a custodian of making sure that your capital is effectively managed. And that having that centralized view was quite important, and giving them the mandate and the policy to say that you're the custodian of that view from a funding perspective, from a liquidity perspective, is where they were able to realize a lot of value.
Just to follow up on that point, we had a question come in that asks whether or not these types of exposures would be captured on a corporate risk register. Is it your experience, Tasha and Mashal, that there are corporate risk registers, that they're comprehensive enough to capture these types of exposures? What would be your experience on this?
So I'd say that that is where the people that we have worked with are wanting to go
to. So they are defining their risk framework, their risk policies, to say these are the kind of exposures we're targeting. And a lot of times when they do the analysis and they're building the business case behind investing in this, they identify exposures they did not even know they had. And they're then able to explain the changes in their financial reporting a lot better because of that. So absolutely, yes, there is a risk register or risk policy framework which is telling you this is what we are actively looking to manage. But what you need to have is the analysis up front to identify what are those. Now, a lot of those things you'd already have visibility of, but when you undertake the business case, you kind of find millions, depending on the size of your organization, of exposures that you didn't initially have visibility of.
Tasha, would you agree with that?
Yeah, absolutely. Yeah, I think that's key. And what we've noticed quite a lot of our corporates when they start going through defining the business case is that when they actually really start looking down the chain of where the different commodities actually feed up to the inventory, for example, there are a lot of risk exposures along the way, and it's about how do they actually manage that. And so, yes, definitely, I agree.
All right, I just want to move the conversation along a little bit. So what we have here is some organizations that are either new on this road or becoming more sophisticated in how they're looking at these types of exposures. What I want to move on to is ways in which they can address and manage those exposures. And in particular, whether or not they take a view that they can live with them, whether or not they take a view that there are natural hedges they can have that work for them, whether or not they are in sync with their competitors, and whether or not indeed there are marketplaces available for them to take hedging positions if they wish to do so. Tasha, how does that conversation go when you're sitting down with your clients?
Funny you should mention that, actually. One of the biggest things that some of our corporates, especially I'll use an example, for example, like chocolates. There's a derivative of a certain product that they require in chocolates that you can't find on the natural market. So, but they need to hedge for it, and they need to actually forecast for it, especially on their balance sheet. So they really and truly need a system that will actually manage that from a refined products point of view, rather than just a purely high-level point of view. So in that way, they will not have the market place to actually go off and buy the derivative, but they will need to actually have the refined product of that particular derivative where they need to be able to manage it. And that's when it starts becoming a little bit more sophisticated, and just having the normal Excel spreadsheet or the normal financial hedging products can't give you that kind of play to address and manage those particular exposures.
Challenge you briefly on that point, though, before I ask Mashal to comment again. If that's the case, is there an argument to say, well, if we're in that product and our competitors are in that product, none of us have got the ability to hedge because there isn't an opportunity to do so, so we all have to find different ways to make our business more competitive or more effective or respond to any cost pressure in that particular area. Is that a fair comment?
Yes, it is a fair comment. What we find, though, is when it comes to those particular derivative plays of a particular product that is on the market, a lot of our clients are saying to us, yes, we are, for example, in the dairy market, okay, they need milk, but from milk they refine, they make numerous different products. So the numerous different products can't be found on the liquid market. So what they'll do is they will hedge and break it down and say, okay, I'll go out and get milk on the normal market, but from there it makes the refined product X, Y, Z, and that's what I have to manage for my particular business. But it might not be the same for the man down the street, because they might not have all those particular refined products, if that makes sense.
Yes, it does. Marshall, I mean, traditionally in Treasury, we've looked at risk management in these contexts and said, well, we'll either accept the risk, take it on board, we'll transfer it if we can through one market or provider, or maybe we'll eliminate it. Perhaps we'll exit that business if we think the risk is too great. How do you see your clients go through that type of thought process?
So I think, first of all, it's the identification of the risk. And if you've identified the risk, there are multiple ways you can manage that risk. If there isn't a liquid and easily accessible platform whereby you can hedge your risk, understanding what risk you're exposed to automatically puts you in a stronger position when you are talking to your suppliers, for example. And you can often agree your contracts in a way whereby you can say, if there's a particular ingredient, I can provide you that ingredient at a certain date. Your contract with me is essentially manufacturing and delivering it back to me. And understanding the market of that ingredient allows you to be in a much better bargaining position. So for example, if you're talking about you're buying a biscuit or you're buying bread, knowing what the underlying market for wheat is, or what the underlying market for sugar is doing, puts you in a much stronger position to negotiate with your supplier. And you can essentially, you don't necessarily often have to even access a traded market, but having that foresight or having this analytical capability puts you in a better position for your procurement team to negotiate. And there will be instances where you will not have an easily accessible or an observable way of managing your risk. At that point, that's when your risk policy comes into play, and you take a view as to, okay, how much of a risk tolerance are we going to have on this underlying? And that's essentially that's driven from your policy, and that comes from your board level almost to say, this is the level of risk we're willing to accept on this. If we can't accept that risk, then yes, you're right. Do we move out from this line of business?
Do you see circumstances in which people understand and accept that risk, but perhaps turn it into a different way into the rest of their business and say, well, if we can't manage it in a marketplace or even through a natural hedge, we will manage it through efficiency or effectiveness in other parts of our business, perhaps in terms of, if we can't manage the product, we can manage the packaging or the advertising. Do you see more of that interplay across the whole of a business's value chain, as opposed to looking at these issues in separate compartments?
Absolutely, and what we are seeing is, if your final product has the cost of various components embedded with it, whether it be currency risk, whether it be packaging, whether it be logistics, transportation costs, we also see corporates saying, let's break this down and look at the components where we can actually take a view. So we can say the logistics cost, we can tie that to something, we can tie that to a shipping index or something like that. So you can break that down and say, okay, out of this final product, it's made of 10 components, we can actually manage 8 of those. So you definitely can go through a process of elimination if you invest in understanding, where your exposures lie.
Tasha, you mentioned an interesting earlier point about the tools that might be available to help people collate their information, manage their information flow, sustain a long-term argument about how they manage their exposures. Perhaps you might care to expand on that just a little bit and talk about the things that you think that treasurers need to have in their minds when they're talking to people that are offering them these types of services.
Oh, very good point, Peter. So a lot of our clients come to us the kind of clients that we deal with, they tend to be what I call commodity intense corporates. So they really use a lot of commodities. So they tend to understand the world of hedging in a degree. Where they come to us for is they say to us, okay, we have this tool where, be it Excel spreadsheet or be it another hedging product, but that hedging product really only understands the financial play. It doesn't really understand the underlying physical play. And every physical commodity has a different nuance attached to it. It also has a different curve attached to it, for example. So the trick would be to really ensure that this tool can understand the movements of the market, can actually place the different kind of elements that control that particular commodity, and also be able to see the movements of the FX against it as well. So to really be able to see this real-time view of the world, because what happens per se, you set up a strategy, you don't have this real-time view of the world, and something happens in the market, and you can only react to it T+1. You would have missed out on all the opportunity to either get out or potentially actually buy more. So to really be able to understand the entire view rather than just a slither view of be it just financial or be it just one particular product or ingredient.
I appreciate that. That's very helpful. Marshall, I have a couple of questions for you. One would be a follow-on from that in terms of when clients are talking with you about the types of tools that they can use, are there any other points or issues that they raise to say, how can we help make better decisions? And the second question I was going to ask was about accounting impacts on making decisions. Perhaps if we take the decision-making process first, and we'll come to the accounting momentarily. It appears we may have lost Mashal off the line just for a moment or two.
I'm back.
Oh, you're back. Excellent. I was asking you whether or not you had any other comments on what Tasha was saying about how your clients choose the tools that will help them. And obviously in terms of, from a corporate treasury perspective, getting executive approval, getting executive buy-in to using particular types of tools. What sort of questions or advice do you have in that area?
So in this context, what I'd say is quite important is essentially looking at tools which are, one, supporting your typical traditional treasury function, so your liquidity and cash management, but integrate seamlessly with commodity risk management as well. So it's quite important that your tools are able to see your cash flow from the commodity side and translate how does that affect your liquidity and cash management and your FX exposure management. So all of these things, I'd almost see it as a triangle. You've got your cash management, you've got your FX exposure management, and you've got your commodity risk management. All of this, for you to actively realize the benefit in developing this capability, this is something that you would need to have together. So that's one thing that I'd advise on. If you're talking about how do you get board level approval, I'd take that back to looking at your benefits case, and it wouldn't take much more than looking at a few market incidents like Brexit or anything like that to say these are the opportunities where we didn't even realize how this was going to come and hit the business, and it did. So it could be something as simple as the price of wheat is indexed in dollars. So how would that affect you? It could be an event taking place somewhere else completely in the world that could affect your commodity and the price you pay for it. So those are the kind of things that you can essentially look at and take a P&L view. This is the profitability. So it's going back to that shift between not just investing in a revenue source, but investing in a cost-saving source, which is actually going to help you realize a lot more benefits, hidden benefits that you didn't even know you could exploit.
All right, thank you very much. I just wanted to ask one supplementary question to go with that, which you may not have caught earlier. We talked here about the economic impact of hedging or not, or the impact of commodity price and value changing, but there is a question about the accounting impact. Have you seen the impact yet of IFRS 9 being significant with your clients?
So I think financial reporting is actually quite important, and what you need to be able to do ultimately is translate what we might call your trading and risk management P&L into your accounting P&L, and that is essentially what we're seeing a lot of investment in, having that conceptual economic value. How do you implement the accounting rules which allow you to correctly and accurately report your trading P&L, but at the end of your reporting period, for example, your month-end period or your year-end period, you're aligning back to your financial reporting, because that's going to link back to your balance sheet strategy, your funding strategy, all of those things. Essentially, you have to link them back. So I have not really seen a project where this has been initiated, where essentially your accounting transformation hasn't been absolutely critical to the success of developing this capability.
And Tasha, I know it's not your specific specialized area, but I presume you would endorse those comments.
So the one thing I will always advise my clients is never ever look at it in silos. Accounting is so intricate in corporate treasury world that when you're looking at the flow of transactions from doing the transaction, be it on Bloomberg, FXall, 360T, all the way through to accounting. And when you design a system or design a platform, always make sure the accountants are there as well, because that's the way you will get a system that really and truly works throughout the business.
And
well, thank you very much.
Just one thing to add. Sorry, apologies. Just one thing to add to that. I think it's quite important, if you do undertake this, is to understand the impact of hedge accounting. So that's actually something that's quite important for our clients.
Yes, certainly the impact of IFRS 9 across all hedging actually will have a material impact, and the ATT certainly has been following up on that, and there's plenty of articles on the Treasury and elsewhere that people can follow. Well, I'm going to draw the conversation to a close at this point, so I'd like to thank Masha Jaffery and Tasha Bota and OpenLink for their support and contribution. I'd also like to thank all of you who have joined in today's session and asked their questions, although I'm sorry if we haven't been able to reach your question in time. As I mentioned at the start, we'll be uploading a recording of this webinar on the ATT website along with the presentation in a couple of days' time, and that link will be sent out to all those of you who have registered. I would also like to draw everyone's attention to one or two upcoming events in the ATT calendar. Obviously, everyone will know about the annual conference, which is coming up in May, but also we have events in the Middle East during the rest of this year, both in May and the Middle East Treasury Summit in October, and the ATT annual conference I already mentioned, which will be on the 15th and 16th of May. All information is available on the ATT website, both on events, but also on our training and professional qualifications. Thank you all very much for listening. If you can spare a moment to provide feedback on the webinar, we would be very grateful. Please select the feedback widget, that's the green box at the bottom of your screen, and the facility to do this will remain open for a short while after the webinar ends. In the meantime, however, from all of us here and online, thank you very much and goodbye.